Hello friends, we are running with the IHT chapter. We have seen the basics of the IHT in the previous sessions, so now we are doing the same chapter and we are moving forward with this chapter. So we have seen the basics, students. If you know that we have seen that there are two possibilities when inheritance tax can come into the picture, and inheritance tax can become your liability. But there are two scenarios where it can come. The first is if the donor is giving gift to the other person while the donor is living, and the donor is died, and then whole the estate of the donor is transferred to their heir or their son, daughter, wife, etc., anyone, or the trust. So there are two possibilities, but we have seen in the last session that we are temporarily talking about, students, the lifetime gifts where donor is transferring the asset to either person or the trust while he is living. So students, here when we are talking about the lifetime gifts, I told you that there are three kinds of the transfer. The first transfer is the exempt transfer, students. The second transfer is, students, the potentially exempt transfer, and the third one is a chargeable lifetime transfer, CLT, which we call. Now in the case of the exempt transfer, students, you know that the transfer between the spouse is called an exempt transfer, and in this kind transfer between the spouses or gift between the spouses will not be liable to IHT in any case. Like it will not be liable in the either gift date or on the death date. It's totally exempt, 100% exempt. But in the case of, students, PAT, it's written over here that potentially exempt transfer, which means that it has either potential of tax liability or either potential of the exemptions, right? So let's see that what will happen, students. In the case of the PAT, you know that on the gift date there is no IHT. But students, if the donor dies within 7 years, then you know that in that case the IHT will arise. So we can conclude that, students, if we are making a PAT, then if the donor dies after 7 years, then it will be totally exempt, right? But students, in the case of the PAT, if the donor dies within 7 years, then there will be the tax liability. Now what if in the case of the CLT, that means a person or donor is transferring the asset to the trust. So in that case, students, on the gift date there will be some partial IHT liability will arise, that we are going to see in the upcoming sessions. Now if the donor dies within 7 years, students, then what will happen? Once again, if the donor dies within 7 years, then additional IHT will arise, students. Please remember, additional IHT. And you will tell me that, sir, if the partial IHT have already been levied, if donors dies within 7 years, then once again second time IHT? Yes, students, a second time IHT, that is called additional IHT in my language particularly, and for your memory that you will not forget this part. And students, what if, students, the donor dies after 7 years? Then in that case, students, whatever the IHT you have paid on the gift date, it's your expense, it's your tax payment you have done, but no IHT on, students, death. So everything is dependent on when the donor dies. In both the cases, students, PAT and CLT, the date of the death of the donor is important, and the duration between the gift date and the death date is, I must say, is more important, right? So we have to see that how much duration is there between the gift date and the death date. If it's less than 7 years, then on the death date there will be no IHT in any of the case, and if it's less than 7 years, then in both the cases, PAT and IHT, there will be the tax liability. So let's move forward. So this is all, students, we have seen in the last sessions. I have just giving you the quick revision. Now let's talk about the PAT, students. We are not talking about anything students exempt transfer, because I told you that it's totally exempt in any case. So let's talk about the pet. Students, I told you that on the gift date there is no IHT. Yes, but students, it doesn't mean that we don't need to do anything. It just means that no IHT liability. We don't need to pay anything, that just means. But students, we have to calculate on the gift date the chargeable amount, or we can say gross chargeable amount. So you will tell me that, sir, why should we calculate any amount if we don't need to pay any tax? Students, once we calculate this gross chargeable amount on the gift date, if suppose in future donor dies within 7 years, then on that date, on the death of the donor, we will pay the IHT on this particular gross chargeable amount, students. So we are currently just fixing the GCA or gross chargeable amount that we will use if suppose the donor dies within 7 years. Got the idea? So we are just calculating the particular chargeable amount which we will use in the upcoming years, right? So if suppose students donor dies within 7 years, then this particular gross chargeable amount we can be used. If donor dies after 7 years, then this we don't need to do anything about this, right? Then this amount, this figure, the figure that we will decide, it will be useless. But still students, we have to calculate it temporarily now. And how do we calculate that particular thing, students? How do we calculate the gross chargeable amount on the gift date in the case of the PAT? So let's see that by taking one of the examples, students. Assume that father have given the gift to daughter. So it means that students, it's a PAT. Yes, it's a PAT. Assume that the date of that gift is 30th April 2019. That means the tax year over here is students 2019-20. So this is the basic things which we have to write it over whenever we are doing any kind of sum, students. This is the one kind of heading, and we are just summarized the important information that we are going to use in the upcoming Proforma. So yes, now students, what is the transfer of value? Transfer of value given in the sum is students £5,000. So let's calculate the gross chargeable amount in this particular gift. The Proforma will start with the transfer of value, students, which is £5,000 as given in the question, and we have to deduct, students, any kind of relief. In this case, students, no relief is given, and I have not yet taught that what is the relief and how many relief will be given. Students, for the F6 syllabus, it's not in the syllabus, and for the P6 students, there will be in the syllabus the reliefs that I will teach you on the upcoming sessions, but temporarily avoid it, right? You just remember the Proforma, but we just simply write it over 0. Then students, we have to deduct the exemptions. Once again, the exemptions are also not yet taught to you, but we will do it for the P6 and F6 both the students. But in this scenario, we are going to claim the full 5,000 exemptions, and the chargeable amount or gross chargeable amount will be 0. You will tell me that, sir, exemptions amount, how did you got the exemptions amount of the 5,000? It's not given in the question, students. Yes, I know the exemptions rules, you don't know the exemptions rules. So I know the exemptions rules, so I just claimed according to the rule. In the after some examples, I will going to teach you the exemptions. So then you will got the idea that how much amount of the exemptions you will going to claim in each sum. But temporarily in this sum, we will get the 5,000 full exemptions. So chargeable amount and gross chargeable amount, students, or we can say gross chargeable amount, will be the 0. So even if students donor dies within 7 years, we are not liable for the IHT because our gross chargeable amount is 0. And if suppose donor dies after 7 years, then it's obvious that we don't need to do anything. Then in that case, after 7 years, It is very obvious according to the rules, students, no IHT, right? But students, here we are currently focusing on the calculating the gross chargeable amount or the chargeable amount. So let's take another example, students. So what is the second example? Second example, we are taking that gift to son, which is once again, students, the pet, and here the date is 1st August 2016. The tax year will be 2016-17, students, and transfer of value given over here in this sum is £30,000. In this case, once again, we are writing down the relief, but there is no information about the relief, so we are not deducting anything. Less, once again, exemptions. In this case, students, according to the rules of the exemption, we are going to claim the £6,000 of the exemptions, and our chargeable amount will be, or gross chargeable amount, GCA, will be 24,000, students. Right? Have you got the idea that how do we calculate the GCA or chargeable amount in the case of the PET? So this is very simple pro forma, students, but now let's come up to the CLT part. Then if suppose, students, if the donor is transferring the asset to the trust, then in that case of the CLT, student, how do we calculate the chargeable amount or gross chargeable amount? Now let's take example of that also. Assume that there is a gift to trust and that is called a CLT. The date of that gift is 1st December 2016. Assume we are once again having the tax year of 2016-17. Assume the transfer of value, students, is 2 lakh pound. Now we are going to start the pro forma with the transfer of value, students. Transfer of value less relief 0 less exemptions. Assume that once again we are claiming the £6,000 of the exemptions. So our chargeable amount over here will be approximate £194,000. Now, students, here we are just getting the chargeable amount. Students, please remember that in the case of the PET, the gross chargeable amount is equal to chargeable amount. But this, it's not the case with the CLT, students. A gross chargeable amount is equal to not just a chargeable amount, that we are going to learn that what is a GCA in the case of the CLT. But for the temporary purpose, please remember that GCA and CA, that means gross chargeable amount and chargeable amount, both are the different things, students. Please do not mix up both the things. So here we have just got the chargeable amount. Please just remember the pro forma. Now how do we calculate the GCA, students? That we are going to see. But one more thing I want to give you the clarity, that students, we are talking about the CLT. That means, please remember, that means that in the case of the CLT, I told you that on the date of the gift also, we do not have just to calculate GCA, but along with calculation of the GCA, students, we also have to calculate the tax liability of the IHT. Because I told you in the case of the CLT, students, on the gift date there will be the partial IHT liability will arise, irrespective of the donor dies within 7 years or after 7 years, right? So here we have to do the two things, calculation of the GCA as well as calculation of the IHT liability. So let's do first thing, that let's calculate the IHT liability. GCA we will discuss on the later part. So we have just got the chargeable amount. Then we can deduct once again, students, nil rate band. Yes, it is given to, for in the case of the CLT, students, total nil rate band available for that is 3,25,000. But I am just writing down another word over here, is that unused nil rate band. Students, that means that in the previous years, if we have used the nil rate band, then we cannot claim full 3,25,000, right? So assume that in the previous, we have to deduct that in the GCA of CLT made in previous 7 years. That means nil rate band, any kind of nil rate band used in previous 7 years of the CLT will have to be deducted, right? And whatever amount we are going to get it over here will be unused nil rate band. This is 3,25,000 students is just total nil rate band. Out of 3,25,000, this is used nil rate band in previous 7 years in the CLT. Right? So how much we have used the how much we have used the nil rate band is nothing but a GCA of CLT made in previous 7 years. So just assume that in the question we have given that we have used approximate 2 lakh pound of the nil rate band in the previous 7 years in total. So now we have got only 1,25,000 of the nil rate band to be used for current gift, for this gift. So that we are going to deduct, and whatever amount now we will get is the taxable amount. Students, if you know that the taxable amount is nothing but the amount on which the percentage of tax will be applied. So I told you that our two rules will be there in the case of the CLT. That first is to calculate the GCA and the second is to calculate the IHT liability. So as I told you that we are first calculating the IHT liability. So IHT liability will be nothing but the whatever taxable amount will be there multiplied by tax rate. So we have just got that IHT liability over here. Very simple, students. Now, what will be the IHT liability, students? 1,25,000, that means 50 and 75 and 50,000 plus 19,000, right? So we will get 69,000 will be the taxable amount, student, in this case. And you will tell me, sir, we have got the taxable amount multiplied by just simply tax rate, we will get the liability. Yes, but students, before applying the tax rate, we also have to see who is paying the IHT. If students, the donor is paying the IHT, then IHT will be levied at the rate of, students, 25%. And if the trust, that means donee, is paying the IHT, that means in this case the IHT percentage will be 20%. So assume that in this case the trust is paying the IHT, then in that case multiply it by 20%. So whatever amount you will get will be the IHT liability. So this will be your IHT liability, students. As I told you, our first task is completed, which is about calculating the IHT liability. Now once again this one more question arises, sir, what is with the GCA? Sir, we haven't yet calculated the GCA. What to do with that GCA? What will be the amount of the GCA? Students, if suppose the donor is paying the IHT, right? And then we will, I told you that we will apply the 25% rate in the IHT, and if trust is paying, then 20%. So students, if the GC, in the case of the GCA, if the donor is paying the IHT, then GCA will be chargeable amount plus IHT liability. And students, if suppose the trust is paying the IHT, then in that case GCA will is equal to the chargeable amount simply. So this is the GCA, and you have to consider that who is paying the IHT, either donor or the trust, and according to that, students, you will get the GCA amount. And students, once you get the GCA amount, in the future, if suppose a donor dies within 7 years, then in that case, students, this GCA amount will be helpful to calculate the additional IHT liability, students. So chargeable amount, the CA, the chargeable amount is just for temporary, students. It will not be used in the future. The GCA, gross chargeable amount, will be used in future, right? Now students, you will ask me that, sir, why do we use two different kind of the figure, chargeable amount, gross chargeable amount? So what is the difference between both these things, chargeable amount and gross chargeable amount? Students, now I am going to explain you that what is exactly the difference between the gross chargeable amount and chargeable amount, and why there are this kind of complex rules for this GCA. Students, the IHT generally is levied on the transfer of value, as you all know, right? In the initial sessions, we have taken the example that students, if the person have total estate value of the 10 million pound and that person is transferring the 1 million pound and now the rest is 9 million pound. Now assume that in this case a donor is paying the IHT. How much IHT will be levied on the 1 million? 0.25 million will be the tax liability, students. And now tell me that the donor have not just transferred the 1 million to his son, but he also transferred 0.25 million for the tax because of this gift. So can we say that in total the donor have transferred the 1.25 million, and or can we say that donor's estate is reduced by 1.25 million? So here the GCA considers not just the transfer of value of the gift, but the GCA also considers if any kind of tax is paid by donor, then the GCA will consider that thing also. So that's why above here we have written that if the donor is paying the IHT, students, then the GCA will be chargeable amount plus the IHT liability. And in this case, students, if the donee is paying the IHT, then in that case the donor's estate will not be reduced by the IHT liability. It will just be the amount of the gift. Right? So that is the logic behind, students, why this kind of complex rules are there for the GCA and what exactly the GCA is. Over here, if the donor is paying IHT, then we have to assume, we have to consider that he is not reducing the estate by just 1 million. Also 0.25 million of the tax payment will affect his estate value. So students, here we are done with the basic things. We will see the exemptions in the later sessions, right? So I hope you got the idea, and now you have command over it. So we will learn first the exemptions and then we will do more sums on these things.